if the PBE is acquired by purchase. To recognize this acquisition is quite simple. First is to recognize property, plant, and equipment. If it is cash transaction, we are going to debit PPE and credit cash. If it is transaction based on the debt, maybe it is note payable. The firm can also acquire long-term assets through equity by issuing stock. The focus of this part is self-construct assets. It is straightforward. When the asset is self-construct, we should include all the costs to prepare the assets ready for use. But the question is, what costs or expenditures we should include? Some expenditures are very straightforward because it can be directly traced to the construct assets. For example, materials, direct labors, and overhead costs. So this is very similar to what we learned in managerial accounting. Construct a property, plant, equipment is similar like produce the product. To manufacture the product, we should include the direct material, direct labor, and the manufacturing overhead. Here is very similar because overhead cost usually does not have direct relation with the specific asset construction. It probably is a firm-wide expenditure, or the expenditure actually is incurred by the whole firm rather than just this specific project. So how to assign the overhead cost to these specific self-construct assets is the problem. There's two ways to handle the overhead cost, because overhead cost can be further classified as variable or fixed. Variable usually is a function of direct material or direct labor. Fixed overhead cost is not assignable directly. So we have two choices. One is to assign no fixed overhead. The other is assign a portion of all overhead costs to the construction process. Obviously, the first one is not preferred because that will understate the value of the asset. So we're going to use the second approach to handle the overhead cost, especially the fixed overhead cost. In this example, we consider the interest cost as an overhead cost. There may be multiple overhead costs to be assigned. In this section, we just use one of them as the example. Usually, when a firm to self-construct a property, plant, and equipment asset, it need to get financing, especially debt financing, to finance this construction. And because debt financing generate interest costs. So in other words, we should consider interest cost as part of the value of the property, plant, and equipment. In this section, we are going to introduce how to determine the amount of interest cost to be capitalized as part of the property, plant, and equipment value. Again, we have multiple approaches. One is no interest cost. The other is all the interest cost incurred during this construction period. But according to GAAP, we should capitalize the actual cost incurred during the construction. So we are going to look for what is the actual interest cost incurred during the construction period. So the construction period basically is start from the first day of the construction till the project or the asset is completely constructed. It may take months or years. So this is considered the construction period. Because this is period, this is time, it will determine interest costs. To determine the amount of interest cost, we consider three factors. The first one is which assets is qualified to capitalize the interest costs. In other words, whether the assets actually incurred interest costs. The next one is capitalization period. Basically is a period of construction. The last one is the amount. So to recognize the qualifying assets is not the topic we covered in this class. All the questions we are given, we assume the asset is qualified. But we still briefly introduce what's the characteristic of the qualifying assets. There are two types of assets are qualified. The first one is the assets under construction is for self-use. That means this asset is constructed for the firm's own operating purpose. The next one is for sale or lease. No matter for what purpose the asset is under construction, we should consider the overhead cost, specifically the interest cost, as part of the value of the asset. The next one, capitalization period. Usually it begins when the construction starts. So what's the sign of the start point of construction? Basically is when the expenditures are incurred. Any activities for readying the assets in progress, interest costs are being incurred. When the capitalization period ends, when it is substantially complete or ready for use. Because the period will determine the interest. So we should make sure the capitalization period is accurate. Last one is the amount. Actually, we have two candidates, but we are going to use the one which is lesser. Two candidates there. First is actual interest cost. That actually is all the debt. Multiply their interest rate. The other one is avoidable interest cost. So avoidable cost is a relevant cost, which is a term we learned in Accounting 212. Avoidable interest basically is if we do not construct this specific asset, this interest will be avoided. So in this example, as I said, this asset is qualified for the interest capitalization. The next one is capitalization period. The project begins on January 1st, 2017 and ends on December 31st, 2017. Basically is 1 year. We also given the firm borrow $200,000. The interest is 12%. This debt, these $200,000 are just used for self-constructed asset. All the interest cost from this debt should be considered as part of this self-purpose equipment. For a firm, it may have multiple debt. We call other debt or general debt. These debt may for other different purpose, not specifically for this project. They are 500,000. Interest is 14. Is 10-year bond. Next one is 300,000. Interest is 10%. The 5 years note payable. From January 1st, 17 to December 31st, 17, this firm has 3 outstanding debt. One is this specific debt. The others are 2 general debt. And we are also given actual expenditures during this year. We have the schedule of the expenditures and their amounts. They also consider the cash outflows for the firm because these expenditures are incurred on different dates. They generate different interest costs. Okay, step 1, it is qualified. Step 2 is 1 year. Next, step 3. To calculate weighted average accumulated expenditures. The interest is the product of the principal and interest rate. And the principal here represents the actual capital was used for this equipment. And as I said, different expenditures on different dates. How long the capital have been used is associated with the interest cost. So what we do is we first calculate the capitalization period. Because the first one is on January 1st. So from January 1st to December 31st, that's a whole year. So it is 12 months over 12 months. This is 1, right? Multiply the actual expenditure. So it is still 100,000. The next one is from April 31st to December 31st. That's 8 months. The capitalization period is 8 months over 12 months. So the weighted average accumulated expenditure is 100,000. November 1st, from November 1st to December 31st, that's 2 months, right? So it's 2 months over 12 months. So the weighted average accumulated expenditure is 50,000. The last expenditure is just incurred on December 31st. So it is 0 over 12. So there's no capital expenditure in terms of the interest cost. Please keep this number in mind because this will determine the avoidable interest costs. Although the actual expenditures totally 650,000, but if we incorporate the capitalization period, so the actual capital generate interest cost per year is only 250,000. That's the reason why we calculate weighted average accumulate expenditures. The next step, we're going to calculate both actual and avoidable interest. First, the actual interest cost. There are 3 debts. One is specific debt for the equipment. The other 2 are general debt. Because the capitalization period is 1 year, so this is very simple. We just use the principal multiply the annual interest rate for each debt. We can get the interest cost per each debt. Total actual interest cost is 124,000. So that's the actual interest. The next one is avoidable interest. So we know 250 is what we calculate weighted average accumulated expenditures. We know when the firm borrows the debt, it borrows $200,000 specific debt for this equipment. But 200,000 is not enough for this expenditure. So the firm needs another 50. Where the capital from, right? It is considered from the general debt. But 50,000, we don't know whether it is from this debt or this debt because these 2 debts have 2 different interest rates. So what we do is we calculate the weighted average interest rate, which is total interest cost per year, which is 100,000, and total principal 800,000. The average interest rate is 12.5%. So when we calculate avoidable interest, there are 2 parts. One is the interest from the specific debt, which is 24, same as this one. The other 50 will consider from the mixed of the general debt, of which the interest rate is 12.5%. 50 multiplies 12.5% is 6,250. So the 30,250 is avoidable interest. Remember, we have 2 candidates. One is actual, the other is avoidable, and we are going to apply the lesser one. Which one is lesser? Avoidable. Okay. That's in most cases avoidable actually is subset of the actual interest. So avoidable will be used. In this process, basically we consider 30,250 are the cost of capital used to build this equipment. It is part of the overhead cost, and we should capitalize this amount as the value of the equipment. We debit this asset, 30,250, and credit interest expense, 30,250. This journal entry actually, we know interest expense is an expense account. When we credit interest, right, so the interest actually decrease. Yeah, that means this journal entry actually capitalize part of interest expense as asset. We can consider this transaction in a different way. Actually, the firm deferred this interest expense recognition by first recognized as part of the value of the asset, and we know equipment will finally be depreciation. Right. So when we depreciate equipment, we are going to credit the control account of equipment, the accumulated depreciation, and debit depreciation expense. So the interest expense was first capitalized as the equipment, and finally will be recognized in the future. Capitalizing overhead, and specifically the interest cost, is because this is part of the expense necessary to prepare this equipment for use. There is another similar example in the PowerPoint. You can go through it as a practice. In that example, the capitalization period is multiple years rather than a 1 year. So go through that example and to see how the firm recognize the interest cost as part of the value of the building. There are some special issues related to the interest capitalization. So if the expenditure are for land, not for resale, it is used as a site for construction, so the interest cost should be capitalized as part of the plant, not the land. However, if the land is for resale, so the interest should be capitalized as part of the acquisition cost of the land. From the prior example, we learned all the expenditures are not paid immediately beforehand. So some of the fund can generate interest revenue, but the interest revenue will not allow to offset against the interest cost. In other words, interest revenue will not decrease the interest to be capitalized.